Hi, I'm Ross Mayfield, investment strategy analyst at Baird, and we are back for another weekly update with our friends at Strategas. Today, I'm thrilled to be joined by technical strategist Todd Sohn to talk all things markets. Todd, how are you doing today?
Hey, Ross, I'm great. How are you?
Doing really well. Thanks so much for jumping on with us today. So, a lot has been going on in the markets over the last week or two, and so I kind of just want to tee you up by asking, what do you make of this market? What do you think is the key driver? What are some key indicators to watch to kind of see if, one, if we make a bottom or if we're heading, further downward? What are you watching and what do you make of this?
Yeah, it's definitely a stressful macro environment out there, and I'd say the equity market is certainly oversold in the short term, right, and likely to see some sort of bounce. Perhaps we got part of that yesterday with yesterday's rally, but just keep the big picture in mind that trends across the globe are still down, and I would be mindful that in bear markets, you tend to see internal pressure dissipate as the index makes new lows. We just haven't seen that yet. Earlier this week, we had about 80% of the S&P 500 stocks trade to a one-month low. That's consistent with, again, the oversold condition, but historically, what you want to see is that new low data start to diverge in a positive manner as the index makes new lows. So less stocks making new lows while the index still is making new price lows, right? That's consistent with internal improvement going on because the indices tend to lie to us and mask what's going on. But it takes time for that to happen, and we don't see it just yet. I would also keep an eye on the put-call ratio. I think it's been surprising that we haven't really seen much panic out of the options data this year. We did get one spike earlier in the week that skewed much higher to the put side, so some anxiety coming into the market. But we're still short there in terms of extremes that we see at market lows. And I would also still mention that the VIX remains around 30. That's just not consistent with the type of panic at major market lows. You typically want to see this at least above 40 or heading towards 50 in some other extreme cases. So we're just surprised that there's really a lack of major panic despite stocks being in a bear market. I think you continue to stay patient here and use any sort of rallies in the near term off of oversold conditions to reduce exposure to your equity allocations.
So talking about, sentiment and positioning and the VIX and put call ratio and how investors are expressing how they feel about the market, one of the ways that they do that is kind of, just money moving in and out of products. Are they putting money into more defensive type products? Are they adding risk on? So you do a lot of work with how that is reflected in ETF flows. What are you seeing there? Are investors, are they hyper defensive? Are they showing any sort of panic, or is it still a little too mellow on that front for your liking?
And I don't think you've seen tremendous outflows from equities just yet. So, not necessarily reflecting any panic there. Although you have seen outflows from certain sectors such as financials and energy. That's more consistent with leaving cyclical type sectors, and you have seen a pickup in flows towards utilities and staples. So there is a defensive posturing there. What I also think is interesting is the flows towards the bond market, right? Bonds are in their own bear market. Away from stocks, but you still have a lot of money going towards long duration funds. And those are the funds that have been beaten down the most this year, down 30 to 40% in some cases as interest rates have risen here. And so I do wonder if you need to see this combo of money leaving both bond ETFs and stock ETFs at the same time before we start to call the all clear. And partially, one of the keys there is to watch the US dollar. The dollar continues to put pressure on stocks domestically and abroad. If you just look at performance year to date, global and emerging equities are down, gold is down, commodities have taken a hit over the last few months. The one thing still left standing is the US dollar, and I think that does hold the key here in terms of overall sentiment and what we'll see from the flow data too going forward.
That makes a ton of sense. And so, thinking about this environment, right? Strong dollar, ascendant dollar, and basically everything else not working or not working to some extent. But, for the opportunistic investor, for someone who wants to get a little more granular and look at some sectors, what sectors look like leadership to you all? Where would you be allocating, within that kind of sector framework at this point in time?
That's a great question. I think if you have to be invested in this market, in the equity market, energy is still attractive to us. I know it's taken a clip here over the last 3 months, but when you look at energy's relative trend versus the majority of other sectors, it's still positive. It's neutral versus staples, which I think makes sense given the defensive environment. And it's negative versus utilities. Utilities have been pretty strong leadership as well. But if I'm considering energy versus communications or versus tech or versus, say, real estate, I would skew towards the energy sector still. They still have the best trends, and the relative portion of this is really important, just that given that everything is mostly going down here. So I think you stick through the energy pain here. Think of it as a longer term allocation. And then if you also are looking for other places, again, staples, thinning internally, but there's still some areas like the packaged foods names that act well, and then utilities continue to act okay, despite the rise in rates, which I think is pretty curious. But again, nothing gets spared in a bear market. So continue to look to those relative charts, such as what we see from energy, in order to find what works in this environment.
Perfect. Well, we really appreciate the insight. I think it's great to end on something actionable. So, Todd, thanks so much for the time as always, and hopefully chat again soon.
Thanks, Ross. Same to you.